All right, well, good evening, everybody, and welcome to our Toronto Options Education Day follow-up. Thanks very much for joining us this evening. My name is Jason Ayres, and of course, online with us here this evening, we have Patrick Ceresna. We both had the opportunity to present to you guys over the course of the Options Education Day, hosted by the Exchange at the Toronto Hilton. We wanted to put together a little special follow-up webinar for those of you that were interested on the practical application of utilizing the strategies that we reviewed throughout the course of the day on Saturday. And it's also a great opportunity for us to demonstrate to you guys just how the Montreal Exchange Trading Simulator actually works. Some of you may have already had the opportunity to access this particular simulator. Others may not know what it is that I'm talking about, but this is a fantastic tool for folks that just want to get a feel as to how these strategies are actually applied under relevant market conditions. It's one thing to understand the theory behind a strategy. It's another thing to get in and actually execute that strategy, understanding the different order types, etc. So we're going to just move forward here with tonight's session. Of course, as always, the information that we're sharing with you guys is for educational purposes only. We're going to look at some relevant stock and option prices here this evening as part of the presentation. We just want you to make sure that they are not recommendations. They're just more for demonstrating the entry and exit techniques for the strategies that we're going to cover here tonight. So as we move forward with the session, the first focus is going to be just a quick look at some of the strategies that you guys had an opportunity to be exposed to throughout the weekend. And then we're going to dig a little bit deeper into some of the common order types that one would use to actually execute these strategies within that particular market environment, and some of the jargon that may be somewhat foreign to you if you've never actually had the opportunity to get in and click these buttons. We're then going to take a look at the MX Trade Simulator. That's a tool that is available to any and all of you if you're looking to actually practice some of these strategies before you get into the live market environment. And then I'm going to take you through a number of different examples referencing these strategies and showing you how we could enter into the trades and how we would look to manage through the positions as well. So I'm going to just move forward here and take the opportunity to introduce Patrick. Of course, as I mentioned, you guys had the opportunity to listen to Patrick during the sessions on Saturday. Always a fantastic speaker. He is our derivatives market strategist and, of course, educating partner here at Learn to Trade Global. He's a Montreal Exchange instructor. He's a chartered market technician. He's a chartered investment manager, and he's a father of 4. I don't know where he finds the time to get things done, but nonetheless, here he is. Take it away, Patrick.
Well, thank you, Jason, and hello, everyone, and thank you for joining us this evening. And we've decided on when we're structuring this that we wanted to really demonstrate the practical application of some of these option strategies using this absolutely fabulous simulator that is on the Montreal Exchange site. I know some of you may have attended the advanced session, and some of you may have already placed the trades. And we tried to make something that's going to be, there'll be something for everybody. So some of those that are brand new to this, we're going to focus on how to place even a basic order. But then the real value to some of you that have already traded options is really how to use the simulator and how to access it and be able to utilize it. So hopefully all of you will gain some really good value from what we're going to be covering here. So the first thing we're, as we're going through this here, we're going to be looking at, 1 second here, let me just, there we go. All right, so what we're going to do is we're going to cover strategies on all the order and specifics of buying a call, buying a put, covered call, protective put, caller, and debit strategy. I'm going to cover all the order terminology and everything you need to do. I'm going to be very efficient. I don't want to say fast, but I want to be efficient at getting through these things because I think that the simulator will do so much more in terms of giving you the practical application rather than a bunch of PowerPoint slides. But we do want to just make sure we get everyone to the level playing field for some of the terminology that's used in actually the placement of these orders. So we want to start with the common order types. And here what you'll see is that there's the opening transaction, and this is going along an option. Now you could go long or buy a call, or you could buy a put. And the specifics, each brokerage will have a different way of actually entering it, but you need to really have 4 criteria when placing the trade. The first thing that you're doing is you're actually buying as an opening transaction. As an opening transaction is you're saying that we're buying the option and it's going to appear in my account as a new position. And the second thing you'll see is in the simulator there's going to be the QTY section, which is the short form for quantity. And this is going to define how many shares, if you're buying stock, or how many option contracts you're going to enter in, recognizing that the option contracts, each one option represents that 100-share multiplier. Then we're going to be talking about how you have to be placing in a price. Now here where they're going to give you the choice to place a market order or a limit order. When you place a market order, what it is doing is that it's saying, you're saying, get me into the market at the best available price. While a limit order, you're specifying a very specific price that you're looking for, and you're willing to be patient in the process of waiting for that order to be filled. And you may not be filled, while a market order, it fills you in the context of the market and gets you in business right there and then. The last section you'll see when Jason's clicking through those buttons is that we're going to be looking at having to choose how long the order will be open or duration. And that means that if you want to put, let's say, a limit order, obviously a market order is going to be filled instantly. But if you put a limit order and you say, I want to get, let's say, 80 cents on this covered call, you don't. That could be order. It could be open for the remainder of the day. Or you could put in instructions, it's good until I cancel it. And then you wait for the volatility of the market over the span of a week or 2 weeks or however long you want to see whether or not the order is filled. When we're looking at a closing a long option, then what happens is that now we have to offset it. Now this position is our account, so Jason opened a few positions and he's going to demonstrate how to close it out. And so offsetting a closing transaction, now that it's in the account, we have to sell it to close it out. And in the same regard, what we're doing is we're going to put in the quantity. We're going to, and you want to put the same quantity that's in the account because you're trying to close something out that's existing in your account. As well, you have the same choice as when you entered, whether you're going to do it in the context of the market, which is hitting the bid, or you want to place a limit order to try to get a very specific fill price. And as well, in the same manner, you can have the order open just for the remainder of the day, or you could put a good till cancel and have the order open in the market for multiple days or weeks and see whether or not you can get a target. It's actually a good till cancel is a very typical thing when you buy a call option, and let's say you paid $1. A lot of people would say, I'm willing to sell it at $2 and make 100%. And so they'll put a good till cancel limit order at $2 to let the order see if you can get a fill at your target profit level. So that's how that works. So just to touch back on those, you got a market order and a limit order. And the key thing here is that a market order will execute your order in the context of the market. You will see market makers and clients with limit orders go into the exchange and post their bids and asks. And what you see is that the exchange will demonstrate to you the very best ask available and the very best bid available. And when you have that bid and ask available, when you hit market, you're buying to the ask or you're selling to the bid. If you're just hitting market, and it's going to get you filled at that price. Otherwise, with that limit order, again, it's where you're not guaranteed to be filled, but you're very specifically asking to be filled at a specific price. The next thing is obviously I was just mentioning in there the time in force. So again, you can leave an order open just for the day, or you can do a cancel. You see a lot of these things apply to stock trading just the same, and it really is the same for options. The bid and ask on a stock, the bid and ask on an option, all the characteristics are the same. The biggest thing that is that in option writing is that there's reverse terminology in terms of execution. And let me explain. Let's say the most common order type from an option writing perspective is the covered call to generate income, and that's the idea where you buy a stock and then you sell a covered call to generate a cash flow on that stock. And this is an interesting thing that a lot of beginners have a hard time grasping initially, is that order is sell to open. Because what happens, you want to realize, is that there's a buyer for every seller in an options market. And so when you're the buyer, someone sold that to you. Often the market maker is your initial counterparty, but a lot of times our retail investors will cross each other at a limit price that's in between the bid and asks. Bottom line is that the seller of the call, and then there's a buyer of the call. When you're a covered call writer and you sell the call, you're selling that call as an opening transaction, which means that covered call did not exist in your account. And you're selling the call covered, the covered call, and it's an opening transaction because it's appearing in your account. See, a lot of people will think that when I sell something, it means it's leaving my account, and they get all confused about that. But recognize, when you're opening a covered call, it's an opening transaction. You're creating this short call position in your account. And therefore, when you have this short call position in your account, how do you close out a short call? You have to buy it back to close it out. And so this is where, on a lot of drop downs, when you're looking at, on order entry, you're going to see buy to open, buy to close, sell to open, sell to close. You're going to see the drop downs, and that's because option writers, such as covered call writers, are going to be doing the inverse of somebody that is buying the option as a tool for participating in the marketplace. And so it's very important to recognize that. And again, Jason will demonstrate that to you on the simulator. I don't want to overly spend too much time on it when he can show you really in the simulator how it looks. The one thing we wanted to point out here is that when you sell a covered call, in the simulator it will show as a red thing, or even in a lot of brokerages it'll show red, but really it shows as a negative. That's the key thing. In a zero-sum game, the seller of the call, as a covered call writer, is short the option. It'll show -10, and the buyer of the call will show a +10. And in the universe of options, it's the open interest. It's about how many buyers and sellers there are that have created these option contracts in the marketplace. And so when we sell an option, it's going to show as a negative. And so this is the tricky part for beginners. When a beginner sees this in their account, they see, let's say, that you sold that option for 40 cents. What it does is it shows as -400 in your account. When an investor sees -400, they actually get initially intimidated. It's like, does that mean I lost $400 just by opening this transaction? And what you want to realize is that it's an accounting step in the accounting in your account, in the way that it's expressed in your account. What you want to realize that when you sell a call option, you collect the premium. So when you sold this, what happens is in your cash balance, you will see, let's say it's a $10,000 account, you will see the cash balance of your account go from $10,000 to $10,400. You make $400 cash flow. But at that moment, based upon its market value, even though you've collected $400 cash and it appeared your cash balance, you have a $400 liability. And eventually you're looking for that liability of $400 to expire worthless, so you got to keep the $400. But at this moment, it's worth $400 because that option's trading, or -$400 because that option is trading at 40 cents for 10 contracts. Now, so if that option goes from 40 cents down to 30 cents, what you've now seen is that the value, or the liability, is -300. That's actually a good thing if you're an option writer, because you have $400 in cash sitting in your cash balance, and the liability is only minus $300, which means that now you are profitable by $100. This is actually the tricky part for beginners to grasp when you're doing the short side. But when you're doing something like a debit spread or a covered call, you're going to see a positive and a negative value, and it's about learning to interpret what it means on there. But recognize that when you're short the option, it's always going to express the market value of your liability beside the option, because the cash has already been credited to you. So we're also going to demonstrate some combination orders. So we're going to actually go in the simulator, and we're going to actually buy a stock and simultaneously sell a covered call in one transaction. It's a combination of the stock. It's called a buy right, but it's demonstrating the covered call position. At the same time, we're going to demonstrate an order where we actually buy the shares and simultaneously buy the put to ensure the downside risk of the stock. So again, it's a way of doing it simultaneously in the simulator, and we'll show you, demonstrate that. We're also going to demonstrate a collar, which is the combination of the two, which is we're going to buy the stock, buy a protective put at the same time as selling a covered call above. And so we're going to see all three of those orders put together as one, and looking at the net cost of the whole transaction in one order ticket. And then we're also going to demonstrate placing in a spread order and showing how the spread looks when it's placed into the simulator. We want to give you guys the confidence to go and open the simulator and actually try this on your own. And tomorrow when the market's live and you guys want to go in there and place one of these, it's an opportunity for you guys to click some buttons and actually simulate these types of orders in the simulator. Understanding the order, well, like for instance, when we're talking about a covered call order, what you're going to see is that we're going to, in the first part of the order, you're going to see we're buying the actual shares, and the second part of the order, of the net order, is we're going to, let's say, sell to open one covered call against the stock. And so we're going to see that we're simultaneously putting two legs of an order into the simulator at once. Subsequently, if we're trying to close it, because there's going to be an order in there for you guys to look at, you're going to see is that in the simulator we're going to go in there and we're actually going to close an existing one as a combination as well. And so it's just going to give you guys an opportunity to see how the math works in placing that in the simulator. Subsequently, what you're going to also see is us place a bull call spread. And so it's a spread order where you buy a call and you sell a higher strike covered call. I'll have Jason give you the little specifics with real stock examples in the simulator, but what you're going to be doing is you're going to be buying to open one of them and you're going to be selling to open the other. And so what you're doing is creating a spread between the two options, and you'll see that you leg it. So you're going to be paying a debit for the first one, a credit for the next one. And because it's a bull call spread, it will be a net debit cost to you. You know, that's a lot of jargon that Jason will really show you with real numbers in just a moment. But you'll see that when we buy to open and sell to open that spread, then you're going to see that to reverse it and to close it out, we have to do place an order to sell to close and buy to close. So notice how, again, those two closing transactions are, the key word is that the first one we're opening the spread, the second one we're closing the spread. And you'll see how that order gets placed in there. So, you know, the best way of actually doing this is to really just demonstrate that. So let's not waste any time and get into the practical application of this in here. And so what we're going to do is we're going to get Jason on here in just a second, but I just want to, guys, introduce Jason again. You know, he was at the options education, and he did the second half of the session in package one, or the basic one. He followed Joe's morning introduction to options, and Jason did a great job talking about the essential tool of achieving your goals using options, and he did a great job, and he's a great speaker speaker on this stuff, and he's the president of Learn to Trade Global and an MX instructor, and he's going to get you on that simulator, and he's going to show you guys how to do all of this stuff. And we look forward to working with you guys in the future as you guys go through your learning of how to apply these option strategies. So Jason, take it away. Thank you, everyone.
All right, thanks very much, Patrick. And as always, tough act to follow. I know that we had a really significant amount of positive feedback from the Options Education Day, and with good reason. As Patrick mentioned, we're going to take a look at the practical application of executing some of these transactions that he was talking about. And we thought that it would be an interesting way to present it, whereby we first ran through obviously the primary definitions and introduce you guys to the basic concepts, but then reinforce those principles by actually going into the simulator and demonstrating just exactly how that that information would be applied in a real-time practical environment. So I'm just going to share with you guys here the actual Montreal Exchange site first off, because many of you probably don't even know where to access this simulated trading platform. So the first thing we want to take a look at here is we are on the Montreal Exchange homepage, and of course, depending upon the language that you prefer, obviously primarily English here right now, but you can also look at the French version. And we need to go all the way down to Trading Tools here, and ultimately click that plus button. And we're going to go all the way down here to this little tab that says Trading Simulator. And when we click on this, I was actually pleasantly surprised at how easily one could actually get in and register for a simulated trading account and actually get to work playing around with and clicking some of the buttons. And so the process by which you're going to access this account is very easy. Now, the reason why I think that this is a very, very important tool is many of you at this point maybe have a broker, but perhaps there's not a simulated trading platform available for you to practice the concepts that we talk about at these Options Education Days. Or maybe some of you don't have a broker. Maybe some of you are just thinking about managing your own capital and you're just not sure where to go. And as a result, you don't have access to get in and actually play around a little bit just to get a feel for how this all works on a day-to-day basis. And so the Trading Simulator is an extremely important tool when you're assessing what strategies are important to you. And I'll go back to just the conversation that I had with our attendees during my session, which is first you got to understand what your objectives are. Second, you have to make sure that you have the ability to achieve those objectives, and you want to do that with as little capital outlay as possible. So I'm going to just go ahead and log in here, and the login is quite simple. It's your email plus whatever password that you've set up presently. And what you'll see here immediately is the dashboard. And right up here across the top of your screen, you've got a nice little summary of your position. Now, I took the liberty of actually creating some positions the other day just so I could have something for you guys to look at that have been active in the market. But it's a really nice, simple overview. You can see, based on the end of the day, I'm down about 0.18% on all of the little positions that I've created. But nonetheless, if you don't like the color red from time to time, trading and investing may not be the business for you. The important consideration here is that it doesn't matter which broker you choose to work with when you decide it's time to actually go live. Their interface is going to look different. They all have a specific branding that complements their own business, and they all have a way by which their designers have place the buttons, and they've titled the buttons. And so it can be a little confusing if you're going from one broker to the next, or if you're going from one trading, going from this simulated trading platform to the next trading to your live environment with your current broker. But what I just want to reference, and it's a real sort of simple analogy. The idea is that when we started driving back when we were kids, 16, 17, 18, we learned to drive on a specific car, and we learned the primary considerations and decisions that had to be made so that we could drive successfully. And chances are you're not still driving that exact same car, but you still know what you need to do when you get in the driver's seat. You still know where where to find the horn. You still know that you need to find where the clicker is, how to turn the wipers on, where the emergency brake is. Even though that vehicle may be different, the principles by which you operate it are the same. So I want you to think about your trading platform in the exact same manner. So at this point, what we're looking at is what we refer to as the dashboard. And it's just a little portfolio summary of the first of all, the open positions that may be in place. You can see that it's actually broken down quite nicely by way of strategy. Just a general overview of the account balance, how much is actually outstanding from a position value standpoint, how much is still available in cash for trading. And then we move down and we see the last orders and transactions that were executed, and happened to be yesterday when I was playing around with this platform. And then we can get down to recent activity, and it's going to do a little overview of some of the various positions as well. So this really just as they refer to it as, it's your dashboard. It's an overview of just what's happening within your account at this present time. Now, there's a couple of ways by which we can actually access the market and start taking action. One is if we go to the quotes page, we could simply, and I took the liberty of typing in Tim Hortons here, but we could type in any symbol that we feel is appropriate, and here's TD, and it'll load up the stock. Or I could determine whether or not I want to take a look at the options chain, and then I could specifically identify which option contract I want to view at that particular time. So let's say, for example, I want to go out to January, and based on TD trading at $91, maybe I want to take a look at the 94 strike calls. I click the little magnifying glass here, and it's going to bring up that information. And in fact, what you can see is this becomes your watch list. This becomes a little page whereby you can actually set up a number of different stocks and a number of different option contracts to watch throughout the day. Now, you can actually trade directly off of this screen. So if I wanted to go in and buy the shares, I click this arrow button. That's a trade trigger. If I and it's not going to trigger a trade immediately, but it's going to bring us to an execution template. And the same goes for the option contract. Or further to that, what we can do is we can simply go over to this trade button, and it's going to bring us to another very simple template whereby we can start taking action on some of our ideas. So the first thing that I want to take a look at is, let's say, for example, we took a look at a chart on Bombardier, and we felt that it was perhaps a bullish opportunity. Well, we select the symbol. We have a drop-down menu now of all the different strategies that we can actually implement surrounding this particular stock. Now, what I want you to recognize is that we're not going to cover all of these strategies here tonight, and in fact, you may not even be permissible to execute these strategies within your broker. And third, there may not be a template that allows you to create the orders similar to what they are, how they're reflected here. So you really just have to have an idea as to what it is that you're looking for. But the first approach is, I just want to buy some stock. So I hit the go button, and as Patrick demonstrated within his little section there, it's a very simple and standardized approach to taking action, and many of you are probably more than familiar with actually executing this particular trade. And you can see we're simply saying I want to buy. Hey, just bear with me 1 second. Let me just type in the symbol. Make sure I have the right symbol in here. BBD. So I type in the symbol. I select the stock. And then ultimately, I have the choice, do I just want to buy one or do I want to buy 100? Well, the important consideration at this particular point in time, in considering that you want to look at integrating options into your portfolio, is that if you are looking at, let's say, executing a covered call strategy, or you're considering that you want to integrate protected puts into managing this particular position, well, then what you want to do is you want to make sure that you're doing this in 100 unit increments. Another example as well, if we take a look at, let's say we want to take a look at at BMO at this point. So we click in Bank of Montreal. We see we're referencing stocks. We hit the go button, and then ultimately we make an adjustment. We want to buy 100 shares. We're going to go down and we're going to choose, do we want a market, a limit, a stop, or a stop limit? Well, we didn't get into stop orders during the presentation, but right now what I want to focus on is just entering the market. So if the market was live right now and we wanted to take action immediately, then what we're going to do is we're just going to say, get me in right now. And we know that we are going to get in buying these shares close to what the ask price is because we buy at the ask. If we wanted to be a little bit more in control of what we pay for the shares, we might look at the bid of, in this example, 68.65 and an ask of 68.72, and we might look at saying, well, I'm going to try to shave a little bit off, and I'm going to put a limit order of 68.70, and that order is going to be good for the day. Now, you could put good till cancel. My personal feeling on putting an order, a good till cancel order in that is an order to buy, is that market conditions are changing every single day. And what was a good opportunity today to get into may not necessarily be a good opportunity 3 or 4 days from now. So I believe that if you use day orders and you're not filled on that particular day, it gives you an opportunity to reevaluate the position and decide whether or not it's appropriate. So we can then turn around, and from there we just click on preview, gives you a little overview. The important consideration here, guys, is this is your opportunity to decide whether or not this is appropriate for your account. Now, I used 100 shares, but your account size, based on your risk management approach, may not allow you to put an order in that is $6,800 worth in one particular security. So that's something that you need to consider. But when it's time to take action, we can click the trade button. Now, of course, because the market is closed right now, what we want to recognize is that that order is not going to be submitted or executed until the next trading day. But that is an order now that's in place in the market, and we can go over here. You see down here it says Order Manager. We click on Order Manager, and it's going to come up with the order that we have in place right now. And then from there, what we do is we have the opportunity to go in and, in fact, manage that or close that out if we indeed feel that it's appropriate. So that's just the simple approach to entering a stock opportunity. Now, let's say we felt that that there was an opportunity to purchase shares in Agrium, and Agrium, for whatever reason, whether it's technical, whether it's fundamental, let me just get the appropriate shares. We feel that there's something lining up, but we recognize that that particular stock can be quite volatile. Well, the nice consideration here about this particular platform is that we can go and we can say, all right, I want to create this as a married put. Well, what do I mean by married put? Well, it simply means that we're purchasing a put option for protection, and we want it to be married to the underlying stock. That means we're not buying this put to speculate on a bearish opportunity here. We're purchasing this put because we genuinely want it to hedge the risk associated with buying the Agrium shares. So we click on that. It's going to pop up a nice little template for us, and here's now where we have to start interpreting the information. So what happens, because this is a combination order, is we're going to buy 100 shares of Agrium at 88, well, let's say we're going to go in at the ask price, 89.02, so we're going to buy it at $89. And we are going to marry, in this case, we're looking at an October 90 strike put, but we might want to go out all the way to January, and we might want to go down slightly out of the money to 88. But you can see the order types are such that we're going to buy 100 shares, and in order to properly hedge those 100 shares, we're going to buy one put contract. If we wanted to buy 200 shares, then we are going to step down here, and you'll see that it automatically upgrades to 2 put contracts. And once again, based on this combination, we can come in here, we can do a market order, or we could look at the potential value of this combination, and we could go at a limit order. So we could look at the cost of buying the shares at 89, and the cost of purchasing the put at $4.85, and we might say, you know, I want to try to put a limit order in here of $83 for the combination. Now, once again, that limit order is not a guarantee that you're going to get filled. And if it is a combination that's sitting in place for the day, if it doesn't get executed by the day's end, then it is wiped off the books and it is no longer a valid order. You're going to have to turn around and reevaluate that as another opportunity. And you know, my main consideration when I'm entering trades is that we can play around with the limit orders and see if we can get a better fill. But if you're a shorter term trader and you want to get in the market, then if you're comfortable with, you know, paying that extra little bit just to get in, then you go at the market order. But here you have a combination. Now I'm going to go through and show you guys in a few moments just what it looks like to see these positions actually already in the account. And we're going to talk about offsetting the orders. But what I want to do first is I want to get you guys through the process of actually entering the orders and understanding just how it all looks when it comes time to actually click the buttons. The important thing that I always suggest is just walking through the position before you click the button. So asking yourself if you know what it means to buy the shares and buy a put option, and what is in fact that accomplishing for you. Or let's say, for example, we liked Agrium and we wanted to buy the shares, but at the same time we wanted to implement the covered call position. Well, we have a nice little template here. If we click the go button, that will refresh everything. And you can see at this particular point in time, what we can do is we can buy the stock and we can turn around and we can simultaneously sell to open this put contract. Now, again, if we want 200 shares and it's going to be truly a covered call position, we actually can write 2 contracts that cover the obligation with 200 shares to cover the obligation. Now, I may decide that I want to go out to January, and I may decide that I want to go out to the 90 strike call option, in which case you can see that we're going to bring in $4.25. So if I wanted to go at the market, then I would be buying the shares at the ask price, $89.02, and I would be selling this call option at $4.25, because remember, we buy at the ask, we sell at the bid. Now that's going to yield basically an average of about 5% over a 3-month period. So again, based on what your trading objectives are, you may decide that this is an appropriate position to add to your account. You can see what the cost of that order is going to be. We click the preview button. It's going to break down the cost of commissions. It's going to break down the estimated order size. And when we're comfortable with that, we click the trade button. Once again, because we're looking at the markets in the overnight session while they're closed, if we go to Order Manager, what we'll ultimately see is now we have 2 positions. And the 2 positions, you'll notice that BMO was just a purchase of the shares. You'll notice that Agrium here is a covered call, and there's a little plus button because that's telling you you've got a share purchase, you've got a buy on that at $88.87, and you've got a sell on that option at $4.65. And at any given time, you can say, I'm not interested in any of this. Click this, and it says, are you sure you want to cancel? Yes, proceed. That's now out of the market, and you no longer have to be concerned with that. Now, what we've done here is we've actually created, thus far, we bought the stock. We've demonstrated a stock with a protective put position. We've demonstrated a stock with a covered call position. But you ultimately may be looking at creating what's known as let me just backtrack here. You may actually be looking at selling a call option that is already on a stock that is already in your account. So let's say, for example, I'm going to take a look at Enbridge here, and we've got Enbridge shares sitting in here. Bought them for $42.42, and we feel that it's appropriate now to generate some cash flow against those particular shares, and we want to actually go in and we want to sell a call option against that. Well, what we can do is, once again, we go to the trade button, and we're going to type in Enbridge. We're going to hit the button there, and we're going to click on Options. We'll click the Go button, and now it's going to give us a little breakdown here. And what we're going to do is we're going to click on the, let's say we wanted to go out to November, and we wanted to sell off the 44 strike calls. Well, in this case, it defaults to buy to open. I need to now sell to open. And I'm going to sell one contract for every 100 shares of the underlying security. And I can see down here that I only have 100 shares. So in order for this to be a truly covered call, I need to sell to open that one contract. If I want to go in at the market, what that means is I'm going to get 28 cents. You know, it's not going to be yielding a whole heck of a lot. You're looking at about 0.7% over the course of the next 40 days. But you also have the upside on the stock as well. So a little bit of money in your pocket, it can be a worthwhile endeavor. So on 100 shares, minus the commissions, you're going to be collecting $18. Doesn't sound like a lot, but if you're doing, if you own 1,000 shares and you sell 10 contracts, that now becomes a more interesting proposition. So again, we preview the order, we run through, we make sure that this sell to open is exactly what we want to do, and we click the transmit button. If we're not comfortable, we cancel. So a lot of times folks think that these strategies need to be executed as a combination order. But in fact, what most brokers will do is they'll recognize that you currently own the shares, and they will understand that you are selling that call option as part of a covered call strategy, and they will allow you to do that. If you went ahead and you didn't own those shares and you look to sell that call option, you're going to be running into some challenges, because there may be some margin issues or trade permission issues in order for you to sell that option, what we would refer to as naked. So that's an example of implementing a covered call on a position that's already in place. Let's jump back to Agrium here. And let's say that we like the stock, but we wanted to protect the downside, but at the same time we wanted to benefit from a potential move to the upside, and we wanted to do it at a reduced cost. Well, what we can do is we can scroll all the way down to the bottom here, and we're going to select callers. And it's going to come up with a template. You'll notice that a caller is what we would refer to as a three-leg strategy. Each position in a strategy we refer to in this business as a leg. And so ultimately we're looking at a three-leg strategy. The first leg is, of course, the stock. The second leg would be the call option that you're selling, and the third leg would be the put option that you're purchasing. Now, you can also leg in and leg out of strategies. So, for example, with that, with the Enbridge position, we were legging into a covered call position. We already own the shares. That's the first leg. We needed to add the second leg. So that would be a terminology that you'd want to be familiar with if you're looking at trading some of these combination orders. But here you can see we're going to buy, let's say we're going to buy 1,000 shares of Agrium. And we're now going to go down here, and ultimately what we want to do is we want to try to collect some premium here. So we're going to go out, we're going to go to January, we're going to go to the 92 strike call option, and you can see that that's actually going to bring us in $3.40. And if we actually take a look at the share value here at 86, we could go down here to the, or 88, we could go down to the 86 strike put option, and we could actually purchase that. So we will be collecting $3.40, and that $3.40 will be going to pay off the $3.95 ask. So that leaves 55 cents cost in this premium. So your average cost basis, if we buy the stock at 89 and our caller costs us 55 cents, then and I'm just going to round to the nearest zero. So that means that this entire position is going to cost us $89.55. Well, we want to recognize with this strategy that we have all of the upside up to 92, which means that we actually, if we take 92 and so we subtract $89.55, we actually have $2.45 profit potential, right, for a $2, basically a $2 risk. So this is how we would interpret this information. And once again, we can go down and we could enter it as a market, and it would calculate all of the information together. It's going to show us that the cost here is going to be $89,579.95. Why? Because the average cost is going to be the $89.02 shares, plus in this case it's going to be a 57-cent combination for the selling the call and buying the put, and then the cost of commissions as well. So we preview that order. Okay, we're comfortable with that order, and we transact when we feel that that it's appropriate. Okay, so again, just walking through this combination, the more legs you add to a strategy, the more time you need to step back and really truly review what it is that you're looking to accomplish. Okay. Now the last couple of strategies I want to look at. We're going to look at buying a call and a put. I saved kind of a more of a simpler combination for this part of the session because it really is a very straightforward process. I'm going to use Agrium once again as an example. I'm not. It's not like I'm suggesting I'm completely bullish on Agrium, but the fact is, if we didn't want to buy the shares, we recognize once again, if we were looking at, let's say, buying the shares of Agrium right now. Let's say we wanted to buy 1,000 shares of Agrium. Well, 1,000 shares of Agrium is going to cost us $89,000 to purchase. If we went in and we looked for a call alternative, we're going to go options. We're going to click the go button. And a general rule of thumb, if I'm trading a directional bias, I want to give myself at least 3 months, and I want to go at the money. So with the shares trading in and around the $89, I would go somewhere around the $90 call option, and you'll notice that again it defaults to the buy to open. I have 4 choices here. It's buy to open because it's a new transaction. Instead of buying 1,000 shares, I could buy 1,000 calls at the 90 strike. If I click market, what you'll see is that is going to cost me $659.95. That's a far cry from purchasing the shares at $89 for $89,000. Now, what I want to consider right now is that maybe this position is a little expensive for my account size. Maybe I don't have $4,659 that I actually care to tie up in this trade. So what strategy can we implement whereby we can reduce our cost basis, we can reduce our risk exposure, we can reduce our break-even point, and if implied volatility is high on a stock that is quite actively traded, we also reduce the impact of volatility? Well, that strategy would be a bull call spread. So we turn around here, and instead of looking at paying out $4,659, what I'm going to do is I'm going to go down here to my template, and I'm going to buy a bear call spread. I click the go button. You'll see now we have 2 legs to contend with. It defaults to October. I'm going to go January. I'm going to go 90, and I'm going to go buy to open 10. And you'll notice with this combination, whoops, I didn't mean January or April, I meant January. So there we go. You'll notice with this combination order, it automatically defaults to a we're buying the calls here, so we needed to edit this. We're going to buy the 90s. We're going to sell off the 94s. Okay, so in this case, bear with me here, guys. Bull call spread is what we want here. Bull call spread. This is why you always want to make sure you're reviewing the template. So we've got a bull call spread. That makes sense. We go down here. We go to January 2014, 90 strike call, and it's a buy to open. And we're going to go down here, January 2014, 94 strike call, and it's going to be a sell to open. If we wanted to mimic that previous transaction here, we're going to adjust everything to 10. And if we take a look at a market order now, what I want you to recognize is instead of that position costing us, let's just preview the order here. Instead of that position costing us $4,659, guys, this position now has been reduced to $1,980. Adding your commissions to it, $1,989. So all we did is we just modified the strategy, and now we have our buy to open, and subsequently as part of that strategy we have our sell to open. So both opening transactions, both recognizing that in order to be a true bull call spread, we have equal number of contracts on either side. Again, if we're comfortable with this risk, we click the preview, we click the trade button, and now that order it will be executed when the market opens tomorrow. So again, we can go to the order manager, and now we can take a look, and we can see there's that AGU combination order sitting here. There's a buy at 465. There's a sell at 289. That combination value reflects the cost basis of the spread. If we don't like this, we cancel it, and we go ahead and proceed with that, and it's now wiped off the books. Let's look at two more here, guys, and then I'm going to just very quickly go through the idea of offsetting some of these positions. So the second consideration is we may actually be bearish on a stock. You know, let's take a look at Suncor right now. Technically, it looked like it was actually starting to roll over as far as shares are concerned. So we take a look at Suncor. We can see that the shares are sitting. Bear with me here. Hold on one second. So let me just go to quotes here very quickly. All right, so here's Suncor, guys, at this particular point in time. So we could actually click this button here if we wanted to go over to the trade button. So once again, I'll just I'll go back and I'll demonstrate that. If you go to the quote page, you have a quote that you want to take action on. Click this down arrow button, and it's going to bring you right to that trade page here. And in this case, what we're going to do is we're going to just go options, click the go button, and we're going to go out to January 2014, and we're going to buy with the shares trading, and we can actually go down here and just refresh how much the shares are trading at. With the shares trading at $36, we may decide that we want a January 36 strike put option. We're going to go ahead and buy to open 10 of them, and we're going to do this at the market, and you can see the cost is going to be that $1,700. But once again, when stocks start to sell, implied volatility increases. How do we offset the impact of implied volatility? We can go and we can create what's known as a bearish put spread. So now we create a two-leg strategy, and in this case, we'll go out to January. We're going to go to the 36 strike put, and all right, we want to make sure this is our bear put spread. So we're gonna this is coming up with the sell to open strategy position. So we may want to do this down at the 34 strike, and we want to keep this at the 36 strike. So right now, what we would be doing is we would be buying the January 2014 36 strike put. It's a buy to open. We're going to do 10 of them, and at the same time, it's going to adjust the numbers up there, and we're going to sell two strikes below at the 34. We're going to sell off the January 34 strikes. We're going to make this a market order, and we preview the order. You're going to see that we effectively have cut the cost of this particular position in half, and if we're comfortable with this, we can click on that and ultimately have that position waiting for the to be filled once the market opens. So let's circle back here for the next few moments, guys. We're getting towards the end of our session here. let's circle back now over to our dashboard. And again, you can get to the dashboard anywhere. But you'll see here that under the Portfolio tab, if we click on Strategy Positions, if we have actually executed these trades as part of a combination, then the simulator, as many brokerage platforms will do, it will track it as a combination. If we wanted to just turn around and take a look at the positions as individual quotes, then you can see here we have all of the individual quotes for the particular positions that we've created. Now, the challenge for a lot of individuals when they are starting to construct combination strategies is that a lot of times if you just simply look at your portfolio holdings, there's really no rhyme nor reason as to just how the information is presented. So it might be alphabetical order, it might be it might be stocks first and then option contracts second, and so you have a situation where you have to filter through the information. Now, you can see that under net quantity here as we go down, the share positions are all 100, the long options are all positive, the short option contracts are all negative. From any one of these lines, we can actually execute a trade and then actively trade that. And so there is a way by which we can actually execute the trade from there. As Patrick demonstrated in the slides earlier, if we go under value, right, remember that the short positions reflect a liability. And so right now we're showing that we maybe collected $20, but ultimately, well, here you go here. We collected $24. That's our liability, and then the current market value is $21. So that means we actually have a gain of 12.5% on that particular position. On the other side of it, we have a cost basis for that Manulife put option down at that we sold at for 29 cents, and you know, we can see that we have a loss of $29 because the current price is 58 cents. So we collected 29, but we now owe back to the market 58. So you can look at it that way, or you can go back to strategy positions. So I'm going to start with sometimes the most challenging first. Now, we talked about legging in and out of positions. So here's a combination order here on Manulife. And so understand that in our positions, Manulife, we didn't see that as part of a bull call spread, but ultimately we have a call in there that's worth $126, and we have a put that's down $21. So we need to consider that as a net combination. We can't see it unless we see the combination here. So when we go to bear put spread, you can see that we're down about $2 or $26 on that position. We can take a look at the net combination here, and once again we see the two different positions. And if we go over to trade, if we want to get rid of this right now, we click that little trade button, and it's going to populate the information here, and you'll notice that right now we have to buy to close the position that we sold, and we have to sell to close the position that we bought. So it immediately creates the appropriate action to get us out of this position. Now, right now I only have one position to speak of, but if I had 10 contracts, my consideration might be I only want to sell 5 because I'm profitable. So I might want to sell this at the market, but I might want to only sell half the position, right? And so it's a way that we simply just do the exact opposite in order to offset the position. So we go back to the dashboard here. Now, for the sake of time, I created a call spread as well on potash. But what I wanted to come down here and show you guys is that we can see that the caller is also created as a combination order. And so what we can do is we can trade that as a net combination, or we can just simply leg out of the position at any time. So if we wanted to get rid of the stock, or sorry, if we wanted to get rid of one of the option contracts, we could. Now we go back to the dashboard here. I want to take a look at the covered call strategy here just very quickly, because you'll see that we implemented the covered call strategy on Encana. And what we want to understand is that we may feel that we don't want to be in this position, or we may feel that ultimately we need to make some adjustments. And you want to recognize that you can't sell the stock before you offset the option position, because if you got rid of the stock before you bought back the option position, so if I click trade here, we go over to the trade page, you would then be short the call option and there would be nothing to cover it. So what you can see here is offsetting the covered call position. What I could do is I could simply sell 100 shares and then buy to close one contract at whatever the market value is. Or if I simply wanted to make an adjustment on the actual covered call position, what I do is I go to my positions, okay, and I recognize that that Encana call here is part of that covered call position, and I might choose to trade that out. So in other words, you'll see that I click on that button, and right now I've got to buy that back to close the position. So I might choose to buy that back at the market, but then ultimately what I'm going to do is I'm going to turn around and I'm going to sell a January 20 strike call option. That's going to be a sell to open to bring more premium into my portfolio. And now what I've done is I've executed an options roll. So we go back to the dashboard one more time and go back to strategies. Guys, you'll see that here we've got our married puts. So it's a combination. In this case, it's Thomson Reuters here bought the stock and ultimately purchased a put option for protection. And you can also see down here that there's two option contracts here to consider as well. What we did is, just as an example, we bought calls on Barrick. The one call position cost us $175. It's down right now, but you'll also see that the TELUS put option, where we said let's look at a bearish example here. Right now, you'll notice that our average cost was $1.23. It's now worth in the market $1.30. So our $123 cost basis in total, because we have to multiply this by 100 and then by the number of contracts, is now worth $1.30 in the markets. So we're profitable. So again, if I actually had 10 contracts, I could turn around and click the trade button, and I could go in here and I could simply sell half my position, so sell to close half, and keep the other half to continue to benefit from a move to the upside. So guys, I'm going to wrap things up here. I'm more than happy to take questions on the ins and outs of this platform right here. There's a couple of considerations I want to leave you with. Number one, this is where you want to make your mistakes. And so if your broker doesn't have a simulated trading platform, and if you're looking at strategies that you believe are going to complement what you're doing currently, but you're just not quite sure, build a virtual portfolio in here and treat it as if it's live. Get used to what an open portfolio looks like on any given day. You'll take a look at the dashboard here. We take a look at the positions, and you'll notice that there's a lot of red and a lot of green. At the end of the day, that doesn't mean that we're going to be losing money in the bigger picture. It's just a reflection of what's happening on a day-to-day basis. So you want to get used to what it looks like within the market, because psychologically you have to be prepared to manage it effectively. Number two, again, it's a place where you could actually practice the mechanical execution of these order types, recognizing that a lot of money has been lost by clicking the wrong button. Every now and again, you hear that, it was why did that stock sell so significantly, or what happened to that option contract? Oh, it was the fat finger syndrome. Well, it's because somebody clicked the wrong button, or at least that's what they say. So we want to avoid that fat finger syndrome. We want to get as proficient at clicking these buttons as possible. And finally, we want to understand not only what it's like to enter the positions, not only what it's like to ultimately maintain the positions in the market environment, but we also want to understand what it's like to offset the positions. We want to make sure that we can, at any given second, if we feel that we need to, get out of a position. You know, the analogy that I use is, you know, if you're a pilot, it ain't good enough just to know how to get the plane in the air. The main consideration is once you got it up there, how are you going to get it down safely and at as little risk as possible to you and your passengers? That's what these trading platforms allow you to do, simulated trading platforms allow you to do. So there's a question here. Does the simulator handle bull put credit spreads and bear call credit spreads? Absolutely. If we go to the trade button here and we go over and we take a look at, let's take a look at TD again here. So we're going to look at TD. You're going to go down here and you're going to see there's a bearish call spread. So let's say I wanted to sell some call options on a call spread on TD above a specific strike. I'm just going to familiarize myself with the stock value. So I could go down here. Shares are trading at $91.18. So what I'm going to do, because I'm creating a bear call spread, is I want to go down here. I'm going to sell to open, let's say the 94s, and I'm going to buy to open, let's say the 96s. And I'm going to do 10 of them. Oops. And so what you'll see here is I'm selling to open the 94s. That'll collect me a premium. I'm going to buy to open the 96s. That's my hedge in case the stock continues to go higher. I click market. I preview the order. And what you'll see, you know, albeit not excessively impressive right now because we're doing October's, but we're going to collect 49 bucks. You know, to make it more worth our while, we may adjust to the January options and look at the market order. Sorry, again, we got to make an adjustment here. We're going to go to the 94s. Now, the reason why, just bear with me one second. Hold on one second. Sorry, I went way too far out. January 2014. Sorry, we're going to go down here. We're going to sell to open the 94s. We're going to buy to open the 96s, and we're going to do 10 of them. So now it becomes an interesting proposition from now until the third Friday of January to execute this. What we would refer to as a bearish call spread. So this would create a liability in our account as long as the shares of TD stayed below 94 between now and the third Friday of January. We're going to collect our $500. Now, recognize that reflects 51 cents per share. Our maximum risk exposure is at $2 between the spread differential here. So we've got 96 minus 94 is $2. That's our maximum risk exposure. That will be the maximum margin requirement minus the 51 cents that we collect as a premium. So effectively, you've got a $1.50 risk for a 50-cent return on this bear call spread. So hopefully that answers your question. You can do the same with a bullish put spread as well. You'll also notice, guys, that you can implement butterfly calls, butterfly puts, condor calls, and condor puts, straddles, and strangles as well. So you can do any of the strategies that you guys have been exposed to during the options education days, any of the strategies that we've taught during our during our presentations with many of the banks and brokers that you guys work with. You'll recognize that you can actually execute them in here. It's a great tool. It is a great way to get in and really familiarize yourself with the strategy. Mike wants to know about ratio spreads. Well, let's give it a go. I could actually sell 10 contracts of the let's see, it might adjust. So maybe we don't have the opportunity to do ratio spreads. You guys will have to get in and play around with the simulator and mess around with some of the different strategies. But that's what this is all about, guys. This is where you click the button without risking your own capital. So, guys, on that note, I'm going to wrap things up for this evening's session. Once again, if you guys have any questions, I'm happy to answer them. Also, just a reminder that you can access this information, lots of information on the exchange, blogs, videos, webinars, trading guides, covered call calculators, options calculators, and of course, the options trading simulator, guys. Books as far as learning about the different strategies. You know, I enjoy Macmillan. You know, he's written many books on the subject of options trading, and it's you know, there's options as a strategic financial tool. Fantastic book. Absolutely, you guys are more than welcome to dig around and see what's out there. You know, if you take a look at the webinars that are on the exchange, little bite-sized pieces, 10 minutes in duration, that give you all the insight that you need. Patrick just had a question. You know, he wants to review the sessions over and over again. 100% repetition is the key. We are recording this session. A recording will be provided to the exchange, and ultimately you guys will be given the opportunity to access the recording. Repetition is the key, guys. I can't stress it enough, both from learning and also from execution and management of these trades. So, guys, on that note, once again, thank you so much for taking the time to joining me this evening, and we're going to see you online again real soon. Bye for now.